You're listening to the Financial Source Podcast, your daily source for macro fundamental education and sentiment updates in the European and U.S. sessions, helping you understand and stay up to date with what's moving the market right now. Here's your hosts, Rachel and Michael, with this episode.
Welcome to the deep dive. You know, the global market right now, it feels like it's operating on this massive split screen.
It really does.
On one side, you see diplomacy starting to thaw out, trade relations looking, well, genuinely more promising between the big players.
Yeah, some positive signs there.
But then flip to the other side, and geopolitical risk is just spiking dramatically. I mean, across multiple critical areas.
It's a defining moment of contradiction, really. We're seeing these fundamentally conflicting signals, and they're driving sentiment across, well, everything. Currencies, commodities, global trade policy. It's messy.
So our mission today is to try and break down these contradictions for you. We really need to understand why the U.S. dollar is soaring, how deep this apparent trade truce really goes, and where exactly global conflicts are heating up most intensely right now.
Okay, let's unpack it.
Let's do it. This whole situation feels like a real financial and geopolitical stress test.
Right. And if you want to understand market sentiment, the best place to start is usually the dollar. It's showing remarkable strength right now, actually extending its recent gains.
And that DXY index is getting close to 100, isn't it?
It is. The DXY, the dollar index, measuring it against its peers, it's aggressively nearing that critical 100 level.
Why is 100 always such a big deal? It always seems like this psychological magnet, a barrier almost. And maybe more importantly, why is the dollar attracting so much capital when, you know, the broader global economic picture looks, frankly, pretty shaky?
Well, that's the critical question, isn't it? The dollar's acting like the world's only real double hedge right now. It's got these two reliable pillars supporting its strength.
Okay, what are they?
First, it's domestic. That sustained hawkish tone we keep hearing from the Federal Reserve. They're signaling absolute firmness, prioritizing crushing inflation over maybe short-term growth worries. And that attracts capital looking for yield.
But, okay, if the Fed is being so relentlessly hawkish, shouldn't that be like spooking global investors a bit? Where's the offset for that risk coming from?
That's the second pillar, and maybe the more surprising one. This renewed optimism around U.S.-China trade relations. We'll definitely dig into that more.
Right.
But when the world's two biggest economies signal even a little bit of stability, the dollar, just because it's the dominant global reserve currency, benefits massively. So it's a hedge against U.S. inflation and a hedge against major geopolitical blowups internationally.
Gotcha. So contrast that really solid dollar with the weakness we're seeing elsewhere, like in the euro. Euro-SHD is sliding down towards 1.15. Why is the Eurozone looking so muted, especially given the high inflation they've also been dealing with?
Yeah, it really boils down to the central bank's posture and patience. Eurozone data just keeps coming in soft, pointing towards stagnation maybe. And the European Central Bank, the ECB, they're showing very little urgency to change course.
So just wait and see.
Pretty much. They're prioritizing patience over being proactive, waiting for really conclusive proof that inflation is truly beaten before they even think about tightening policy more. And that directly leads to a softer currency. We see a similar thing with the Japanese yen, actually. It's trading weaker, above 154 per dollar. There just aren't strong domestic economic drivers in Japan right now to really support a rally.
Okay, now the Swiss franc, I find its behavior a bit counterintuitive. It's meant to be that classic safe haven currency, right? But it's lagging behind the dollar. What's happening there?
It's fascinating, isn't it? The franc is being pressured kind of precisely because that safe haven status isn't needed domestically. Inflation actually slowed unexpectedly in Switzerland.
Oh, interesting.
Yeah, and that signals to the market that the Swiss National Bank, the SNB, is probably comfortable with its current stance. They don't feel forced to tighten further, and that takes the immediate upward pressure off the franc.
Right, okay. Then there's the Australian dollar, the Aussie. That's a key commodity-linked currency. It's holding surprisingly steady, even though we saw some disappointing manufacturing data out of China, which is its biggest customer. Why is the Aussie so resilient?
Well, traders seem completely focused on the immediate future there. They're pricing in the potential for forward guidance from the upcoming Reserve Bank of Australia meeting, the RBA.
So ignoring the past data?
Effectively, yeah. The market's basically skipping past yesterday's weak Chinese numbers and betting that the RBA will offer some clarity or maybe even a potentially hawkish signal that could support the Aussie dollar going forward.
Okay, that brings us right back to that source of optimism we keep mentioning. U.S.-China relations, let's talk diplomacy, tariffs, the whole trade picture. We've had some remarkably constructive language recently.
We really have
Yeah.
a significant thaw at a high level. President Trump described his meeting with Xi Jinping as, quote, incredible, and maybe more importantly for the markets. He expressed a strong willingness to actually remove that extra 10% tariff currently in place. He signaled he expects a, quote, long-lasting deal. That takes a huge layer of trade uncertainty off the table.
That sounds like a major step towards de-escalation, which, should be welcomed. But almost immediately, we run headfirst into that core contradiction that seems to define the entire relationship, the whole technology friction.
Precisely. The tariffs on physical goods. They seem to be negotiable, maybe serving more as a bargaining chip. But that underlying struggle for technological supremacy, that seems relentless.
Yeah.
Even while the high-level talk is constructive, the U.S. just reaffirmed restrictions on exporting advanced NVIDIA chips to China. These chip restrictions really represent the non-negotiable core of this great power competition.
So we can trade more soybeans, maybe, but we can't share the next generation of AI tech. That friction really defines the future, doesn't it?
It absolutely does. And just to underline how critical this conflict is seen, we know the president characterized the Supreme Court tariff case as potentially one of the most important in U.S. history. This isn't a side issue. It feels like the main event.
Is there any sign of flexibility, any negotiation on the tech side coming from Beijing?
There is a signal maybe of willingness to negotiate around the edges. China's Commerce Ministry announced it will review exemptions on the Xperia chip export ban.
Okay.
It shows they're willing to engage on specific issues within the tech space, perhaps, rather than just adopting a purely confrontational stance across the board.
And we do have some tangible wins, particularly in agriculture. That's often like a litmus test for the health of the relationship, right?
Definitely.
China is reportedly looking to buy U.S. wheat for the first time in a year. That's a measurable improvement in actual trade flow.
It is, and if you broaden the lens across Asia, you see a wider effort to sort of stabilize regional supply chains, probably in light of all this U.S.-China volatility.
Makes sense.
South Korea and China, for instance, just signed 7 memorandums of understanding, MOUs. These include a currency swap agreement, which is designed to insulate them a bit from dollar swings, and also a pledge to cooperate heavily on emerging tech like AI and biopharma.
So regional powers are actively building their own structures to manage and hedge against this global instability.
Absolutely. Look at Japan's Prime Minister Takaichi, maintaining a very delicate balance, emphasizing constructive trade with China while at the same time reaffirming the strength of the U.S.-Japan alliance.
Tricky balancing act.
Very. We also saw Canada and Japan exploring ways to expand their already pretty robust $32 billion bilateral trade relationship. So trade is definitely moving forward, with Asia seemingly doubling down on regional cooperation to mitigate some of that global risk.
Okay, that optimism about trade, it really sets up a kind of cognitive dissonance when we turn to our next section. Commodities. We're seeing cautious supply management in oil, but then this surge in industrial metals that seems to be betting against a slowdown.
Yeah, let's look at oil first. Prices actually reversed their early gains, and that was a direct reaction to the OPEC Plus decision. They agreed to only a modest 137,000 barrels per day production increase for December.
Okay.
But the really key detail is the planned pause in production adjustments that's scheduled for the first quarter of 2026.
Right, with WTI currently near $61 and Brent around $64. What's the strategic meaning of pausing adjustments way out in 2026?
Well, this move is widely seen as a cautious step. It sort of acknowledges a potential supply surplus early next year. OPEC Plus seems to be trying to manage demand concerns, from a potentially slowing global economy while still maintaining some pricing power. They're basically signaling to the market, look, we won't flood supply if growth forecasts get revised down.
Yeah.
It's very much a future-focused balancing act.
And yet the base metals seem to be completely ignoring this caution. Aluminum and copper, they dropped initially after that soft Chinese manufacturing data, but they recovered incredibly fast.
That quick recovery, that's the sign of, high conviction money flowing in. It suggests there's underlying demand strength or maybe tight supply narratives that are just overriding those short-term economic worries. Wow. Aluminum, specifically, touched its highest level since 2022. That's highly impressive. And copper, often seen at the barometer for global industrial health, it's trading near $10,900 per ton. This signals that industrial supply chains are either facing some critical constraints or maybe placing a heavy bet on strong future manufacturing, kind of overriding that recent soft data point.
And of course, gold, the classic safe haven, sits somewhere in the middle of all this economic complexity.
Yeah, gold briefly dipped below $4,000, but it quickly bounced back towards $4,028. That rebound is fundamentally supported by that lingering geopolitical uncertainty we're about to dive into. When the risk tone in other markets gets weaker, gold remains that crucial hedge against global instability.
Okay, that geopolitical instability is the perfect transition to our final section. If trade is showing us collaboration, the military landscape is, well, it's screaming escalation. We have to start in the Middle East, where the conflict has significantly intensified.
Yeah, operations have definitely deepened. Israeli forces intensified their presence in southern Gaza, with artillery strikes reported in Khan Yunis. The conflict seems to be moving into a new, maybe more kinetic phase.
And the rhetoric from leaders in the region is getting sharper, bolder, too. Prime Minister Netanyahu warned about possible expanded action against Iran-backed groups, specifically naming Hezbollah and the Houthis.
And Iran's response immediately cranked up the tension, avowed to rebuild its nuclear facilities, quote, with greater power. The whole dynamic feels like it's pushing closer to a wider regional conflict, creating probably the single biggest risk factor priced into the global economy right now.
Shifting over to Eastern Europe, we're also seeing these confusing and frankly conflicting signals about U.S. aid and military posture towards Ukraine.
That confusion is immediate, yeah. Reports initially indicated U.S. approval for potential Tomahawk missile transfers to Ukraine. That would be a massive escalation in terms of capability and range.
Huge deal. But then almost immediately, we got that crucial caveat.
Right. President Trump later publicly said he is, quote, not really considering the move. That kind of contradiction creates instant market and political anxiety. It signals perhaps deep internal division on strategic alignment.
Yeah, definitely sends mixed signals.
And regardless of the political posturing, the kinetic action just continues on the ground. Russia confirmed new strikes targeting Ukrainian energy and gas infrastructure. Meanwhile, Ukrainian drone attacks reportedly damaged vessels down in Tuapse on the Black Sea. Energy infrastructure clearly remains a primary active target for both sides.
Okay, just briefly, is there anything else listeners should be watching on the global security radar outside those main hotspots?
Well, we heard reports about potential plans for a new Trump administration mission targeting drug cartels in Mexico, though it was noted that any talk of troop deployment was not imminent.
Right.
We also saw the U.S. threatening to cut off aid to Nigeria over concerns about religious violence there. So it shows a broad focus on security issues, extending beyond just the main theater conflicts.
So we have these really intense escalations, Gaza, Ukraine, even potential action related to Mexico. But there is one critical line of communication that seems to be holding firm between the major powers.
Yes, and this is maybe the single most important detail in this whole section, really designed to prevent the absolute worst-case scenario. Defense Secretary Hegseth confirmed that direct military communication lines between the U.S. and China are operational and being maintained.
That's crucial.
Absolutely. These lines are specifically intended to prevent conflict escalation that could stem from miscalculation or some kind of accident. It shows that even as the competition intensifies, both sides recognize the critical need to avoid stumbling into an accidental war.
Okay, let's try and bring this all together for you listening. We've seen a firm dollar supported by both the Fed and that renewed trade optimism. We've got surprising strength in key base metals like aluminum and copper, suggesting industrial demand is, well, pretty robust. And diplomacy is yielding some tangible economic results like that wheat purchase we mentioned and the consideration of rolling back tariffs.
Correct. But, and it's a huge but, this economic progress is happening against a backdrop of rapidly escalating military tensions, particularly in the Middle East and Eastern Europe. Plus, that core non-negotiable struggle over tech supremacy, embodied by those chip restrictions. It truly is the definition of a split-screen world.
So the takeaway here seems to be that global stability right now is relying on this deep contradiction. Diplomatic talks are clearly yielding some economic cooperation,
while the underlying struggle for power and technological dominance just remains relentless. So the question, I think, for you to consider is this. We know those military communication lines are open right now, acting as a kind of an emergency brake. But which thread, the economic collaboration that's giving the market some confidence, or the geopolitical friction that's driving military action, which one will ultimately dictate the direction of global stability over, say, the next quarter? That tension is what will define the next move.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.